Next, we'll turn our attention to the state benefit regime, which is administered in the UK by the Department for Work and Pensions. And I think it's important before we start to look at some of the different types of state benefits that are available to get a general understanding that this is trying to provide a basic level of support only for you. So state support really is designed in the event of unemployment, incapacity, whatever the case may be, that it just provides the absolute basics for you. Some benefits that are provided by DWP are based on contributions that you make to the welfare state through your national insurance contributions. So you'll hear us talk about some benefits that are NIC dependent. The amount of NICs you pay is determined by your income each year. Provided you pay enough, irrespective of your level of income, you will gain credits, and those credits can essentially be used to access state benefits that are contribution based. The classic example of that is the state pension. There's also some benefits which are means tested, i.e. they're dependent on the individual's wealth or income levels, and high wealth or high levels of income can preclude from eligibility for certain benefits. We'll also explore the fact that there is a benefits cap that applies where essentially a range of benefits are being claimed by a particular family, and this is dependent on the location and the family situation that we find ourselves in. So state benefits can typically be categorised into these four main areas: benefits for family and children, benefits for those unemployed or those that are on low income. We've got disability and sickness benefits for those who have an incapacity to work, and we've got retirement benefits for those of us, of course, that are in later life. And we'll be exploring under these four categories some of the state benefits that are actually within this exam. One thing I will say is that you only need to know the basics here and understand the general premise of what sort of benefits might be available in certain circumstances. Whilst it is not completely unheard of for you to get questions on which are taxable, which are tax-free, or which are actually means tested, or which are contributions based, those sorts of questions in this exam are rare. So first and foremost, get to know the basics. So let's first look at the benefits that are payable for family and children, and we're going to look at child benefit and we're going to look at the child tax credit. And we'll deal with the child tax credit, the bottom one first, because this is one that essentially is aimed at lower earning families only. So not everybody qualifies for this. In fact, most families don't. And it provides a means tested benefit that's non-taxable. In other words, they will look at your income and your wealth in determining eligibility for your child tax credit. It's slowly being integrated this into the universal credit, which is the government's new singular state benefit scheme that is going to have specific elements that will take over from certain state benefits going forward. Child benefit is far more common. This essentially, in the first instance, is available to anyone with a child in the United Kingdom under the age of 16 or under the age of 20 if the child remains in full-time education. It's a non-means tested benefit. It's also non-taxable in its payment. It can be paid to either party within a family, and actually, generally speaking, it will be paid out to them on an ongoing basis straight into your bank account in order that you could actually meet the basic childcare requirements. When we talk about this being non-means tested, it's important to understand that whilst your wealth itself is not considered, there is a tax charge that applies where any parent has an income in excess of £50,000. Again, we won't need to know this in detail, but if one party within the adult's family essentially earns in excess of £50,000, then they're going to have to pay some of it back. And if one party earns more than £60,000, they will need to pay it all back. So it will be paid to every family in the first instance. It's up to each family to understand their own circumstances, and if they need to pay some money back, they'll do that through their self-assessment. The tax charge is applied essentially at a rate of 1% for every £100 that effectively you're over £50,000. So somebody who earns £55,000 would have to repay back half of the child benefit they've received through self-assessment. We've also got maternity, paternity pay and maternity allowance to consider. And the key thing about this is that obviously this is about having the birth of a child, essentially. So maternity and paternity pay is for new mothers and fathers, and it's designed essentially to allow time off in the first instance for the actual family to spend with a newborn. 90% of the pay, the wages, is paid for 6 weeks for maternity or 1 or 2 weeks for paternity, and then a set rate for maternity of up to another 33 weeks can be claimable. In other words, you originally have it linked to your wages for a set period of time, but then it drops to a set amount. It's employed parents only that can get maternity and paternity pay. In other words, if you're self-employed, you won't be getting this. You essentially will be getting the maternity allowance. It's contributions based, i.e. NIC dependent, and it's a taxable benefit, as anything that has the word pay in is. Anything time that you see the word pay, you should recognise the fact that it will be contributions based, and it will also be taxable in payment. Those that don't qualify for maternity or paternity pay, i.e. those that are self-employed or did not work long enough with their employer, which was 6 months, to qualify, will essentially get the maternity allowance. This is also contributions based, but is non-taxable in its payments, and generally speaking is just lower than the actual maternity paternity pay when everything comes out in the wash. So classic example here might be a question of somebody that's self-employed and had a baby. What will they qualify for? They'll go with the allowance rather than the pay. You might also see a question where somebody's only been employed for 3 or 4 months. In that situation, they won't get the maternity pay, they'll get the maternity allowance. So turn our attention now to unemployment and low income benefits. And we've got 3 main state benefits to worry about in the first instance here. And on the next slide, we're going to look at further support that's available for those of us that have mortgages. So job seekers allowance, the unemployment benefit, essentially. It's been around for a while, this is. And obviously this is those that are fit for work and are out of work. So there's different levels dependent on your age, your marital status, also whether or not you the length of time that you've been off work will impact on the amount of benefits you can claim. So it's a contributions based benefit for the first 6 months. Thereafter it's means tested. So obviously they'll look at things like your ongoing income, if there's any income coming through from investments and stuff like that, and also your wealth after 6 months. It's a taxable benefit, but it's only payable to those that are actively seeking work. So you will be under total assessment and long-term assessment here. Then we've got income support. Income support essentially is being integrated into universal credit as well. This is a low-income family support mechanism for those that have got children with severe disabilities. Generally speaking, means tested, non-taxable benefit. A lot of income support has actually been pulled into other areas, and you need to consider it purely from a high level aspect. Working tax credits are a top up for those that work in excess of 16 hours per week. These are means tested, non-taxable benefits designed to make the difference between someone giving up the job because they're better off on benefits to sticking with it and working it through. So if you do qualify for working tax credit, the chances are is that you've actually got relatively low income, and this is designed essentially to make the difference, to make it all worthwhile for you to actually bother to go to work. So we mentioned support for mortgages on the previous slide, and we're going to talk about something. It used to be a state benefit, but no longer is. The whole premise of the support for mortgage interest, or SMI as it's known. This is a really popular source of questions in this exam. So this essentially is where you're off work for whatever reason for more than 39 weeks, assuming that you don't qualify for certain pension credits, and you essentially will be provided with support to keep your mortgage interest paid, to keep the roof over your head. So you qualify normally, ordinarily, if you've got a mortgage and loan up to £200,000, you're a homeowner, you've been off work for 39 weeks or more. Essentially, you can apply for a loan to pay the interest on your loan to the house, to your mortgage company, and that loan will build up and you'll essentially pay that back in the future, normally when the house is sold or you transfer the ownership of the property. Now, there's a certain differential to this. If you are on pension credit, there's no waiting period there. It's also a reduced amount of interest that's payable, up to £100,000, not £200,000. But the general idea here is that you will have to pay this back. It is a loan rather than a state benefit in the rawest terms that we can offer you. Next up, disability and sickness benefits. And the first one we're going to look at is statutory sick pay. And statutory sick pay, under normal circumstances, is only payable to those employed. There are, as I speak this, certain concessions for the self-employed with SSP due to the COVID-19 situation, but that's not normal. Under normal circumstances, SSP is only payable to those that are employed. You need to be ill and off work for at least 4 days in a row to be paid anything through statutory sick pay. Generally speaking, once it starts, it's payable for up to 28 weeks or until you return to work. Your entitlement is based on contributions that you make to NICs. This is a taxable benefit. It's actually paid by your employer. So if your employer actually offers you extended terms of sick pay, in other words, if your employer offers you pay off work sick for like 2 weeks or 3 weeks, then you won't get statutory sick pay directly. You'll get that payment by your employer instead. Now, for those that don't qualify for statutory sick pay or are off work long enough past 28 weeks to stop being eligible for SSP, then there is the longer term employment and support allowance, which was the successor of incapacity benefit. This is paid to those with illnesses or disabilities, and there's various schemes within the ESA aimed at getting individuals back to work. So there's rehabilitation schemes and all sorts that sit behind the ESA framework. It's contributions based and income based in different variants. So in other words, there's 2 different ways that you could actually gain access to this, and it's at 2 different levels dependent on the time you're off work sick. Contributions based is not means tested but taxable, and the income related is means tested but not taxable, and that generally kicks in after a period of assessment. So the self-employed and employed qualify for the ESA. Now I'm going to turn our attention to other disability and sickness benefits, and these typically are for more serious ailments and where care is required. So personal independence payments have been introduced essentially to replace the disability living allowance. Anyone that's under the age of 16 may still qualify for the disability living allowance, but those aged 16 to state pension age in the main have been transferred onto the PIP and will get the personal independence payment instead. Based on individual assessments and your needs, based on certain inability to undertake certain activities of daily living, a non-taxable benefit can be paid. So this is under state pension age with a disability that essentially is going to stop you from undertaking normal activities of life. When you reach state pension age, or if illness turns against you after your state pension age, then the attendance allowance kicks in. So in many respects, attendance allowance replaces PIP for those that have a disability when they reach state pension age. It's a post-state retirement age benefit, it's not means tested, and it's a non-taxable benefit designed to be paid to those, again, that cannot fulfil certain activities of daily living. Support can also be available for carers of people that can claim attendance allowance. That is beyond the scope of what we worry about for this exam. So the last element of the state benefits section, we're going to concentrate on the retirement benefits, and we're going to very briefly look at the single tier state pension and the basic state pension. And this gets expanded on later in this module, so we won't go into this in too much detail at this stage. So essentially, and for those retiring before the 6th of April 2016, there was a qualification for the basic state pension, which was based on your NIC records and was a taxable benefit that essentially would be paid to you. And you could have certain top-ups to the basic state pension, SERPs, S2P, graduated retirement benefit. We'll look at that in more detail, as we just said, in the coming slides. On the 6th of April 2016, essentially a new single-tier state pension started, replacing the basic state pension and those top-up schemes. It essentially maintained a lot of the features of the basic state pension, but was designed to provide a more simplistic approach to our state pension requirements. There was a change for the qualifying criteria, but it remained contributions based, and it remains a taxable benefit, albeit it's always paid gross to every individual that receives it. So just before we close this section off, state benefits in general are going through a bit of an overview, and we've got a rolling out of universal credit across the country by postcode essentially, which rolls up certain state benefits into one. So child and working tax credits, job seekers, income supports, ESAs, to name a few, will essentially be rolled into universal credit, and people will apply for universal credit and qualify for certain elements of that credit dependent on their circumstances. So that's one of the significant changes we've been through. We've also recently seen the introduction of a bereavement support payment, which is designed for people that essentially die under state pension age. And depending on your circumstances, a lump sum and an ongoing monthly amount will be paid for 18 months post your death. So it largely depends on dependent children here. If you die with dependent children under state pension age, then a £3,500 lump sum and 18 monthly payments of £350 will be paid by DWP. If you die under state pension age without children, a lower amount of £2.5 will be paid, and £100 a month will essentially be paid for that 18 months, designed to cover the cost of borrowing for a basic funeral and also to provide a little bit of support to whilst the person perhaps needs to get the house in order before going back to work. One other state benefit that's not mentioned too much in the book, but is mentioned briefly, so we'll cover it, is that of the statutory redundancy payment. So this is not really a state benefit as such, because obviously any redundancy payments are largely going to be paid by your employer who's made you redundant. But if you get made redundant, essentially DWP will not expect tax to be paid on the first £30,000 of benefits, and any benefits payable above £30,000 being taxable. Lots of people actually transfer the excess to things like pension plans to avoid said tax. Based on your year's service, obviously, this is again designed to support in part through a lack of taxation those that are unfortunate enough to lose their jobs.